Modern banking runs on a simple principle. You deposit cash, the bank records an IOU, lends most of it back out, and the whole system stays standing because payments clear in the background, and central banks act as the emergency backstop. But this isn't a modern invention. Ancient Rome pulled off a surprisingly similar version of that, without apps, without ATMs, and without a central bank. It wasn't a unified empire-wide banking system like a modern national system, but Roman credit and finance could extend across long distances and also included cashless payments. So how did the Roman banking system actually work? A crisp morning at the port of Portus. A merchant decides to settle at the port. He wants to deposit 20,000 denarii, enough for any merchant to retire off. He walks to the taberna where an argentarius is serving other clients. The argentari and the numulari first count and assess the metal, checking weight and purity, so every coin is verifiable and standard. The argentarius then asks a simple, radical question: safekeeping or to put the money to work? If the merchant chooses safekeeping, the coins are held intact. If he chooses interest, the argentarius writes the merchant's name and balance into the account book. His money ceases to be metal in a pouch and becomes a credit on the ledger. The banker can now lend those funds, finance auctions, or underwrite voyages, promising repayment in equivalent value plus agreed interest. That bookkeeping step is genius. By turning bullion into recorded claims, Roman bankers made wealth portable and divisible without physically moving coin. Payments could be settled by entries and written orders, bankers could pool and reallocate capital, and merchants could fund long-distance trade without hauling chests of metal. Standardized assessing and rigorous ledgers created the trust and legal clarity markets need. In short, Roman banking didn't just keep money safe, it converted metal into credit, liquidity, and organized risk, unleashing commerce across the empire. And so, the merchant chooses to put his money to work. After all, he has worked hard. A week later, the merchant wants to buy a small warehouse space near the docks. He could show up carrying heavy sacks of coin, slow, risky, and basically begging to be robbed. Or he could pay cashless. But how did the Romans manage to achieve cashless payments 2,000 years ago? Big purchases in Rome often couldn't be paid by physically hauling coin through the streets, so they leaned on documentation, debts, claims, account entries, because writing could move wealth faster than muscle. The merchant can settle big purchases, pay workers, finance shipments, even participate in auctions without ever touching most of the coins again. The argentarii became a kind of financial switchboard for city life. But there was one issue with Rome's banking system. There was no central bank, which meant there was no lender of last resort, no institution to stabilize panics, no authority guaranteeing deposits when things went wrong. In good times, this didn't matter. As long as confidence held and borrowers repaid their debts, the system hummed along. Bankers cleared payments, merchants expanded trade, and credit flowed through the cities like water in an aqueduct. But the moment trust cracked, everything depended on the individual banker's reputation and reserves. A rumor, a bad loan, or a political shock could trigger a run. If too many clients demanded their money at once, an argentarius couldn't magically summon the coins. They were already lent out. And unlike modern banks, Roman bankers couldn't call the state for emergency liquidity. When they collapsed hard. We have records of bankers who vanished overnight, shops shuttered by official orders, and debt chains snapping through the economy because one node failed. A failed banker didn't just go bankrupt, He could drag every linked contract and borrower down with him. And yet, despite having no central bank, Rome's financial system survived for centuries. Why? Because it was decentralized, reputation-driven, and deeply embedded in daily commerce. Each banker lived or died by trust. Lose it, and your business evaporated. Keep it, and your books became as good as coin.